Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial jungle and make it make sense. Today we're looking at Accession Corp, and let me tell you, this report is less about massive financial statements and more about the behind the scenes, deal making and future promises, or as I like to call it, the business behind the business. Before we dive in, if you like getting these reports decoded without all the jargon, make sure to smash that subscribe button. And hey, we've got a fantastic community over on Discord sharing insights on everything finance, so join us there too. The link is in the description below. So what are we looking at here? Accession Corp, which is essentially a company formed to buy or merge with another company, is filing a Form 8K. Think of this as a current report for important events that happen between their bigger quarterly or annual filings. This particular filing is all about some key agreements they've entered into. The big date here is June 9, 2025, and that's when some of the most important events in this report happened. First off, they are an emerging growth company. This means they get to follow some slightly less strict rules for a period, which can be good for them, but means we might not get as much detailed financial information as we would from a more established company. Now, like most of these reports, they start with a bunch of legally important stuff about forward-looking statements. This is basically a disclaimer saying that anything they say about the future, like expected plans, benefits of deals, or how well they think they'll do, might not actually happen. They list out a ton of risks that could make these future predictions wrong. Everything from not getting approvals on time to things going wrong with integrating businesses, or even just announcements hurting their stock price. It's a standard but important reminder that the future is uncertain in business. They mention the SEC a lot, which is the Securities and Exchange Commission, the US government agency that oversees the stock market and makes sure companies tell investors the truth. This part is all about where you can find more information if you're really interested, like other filings they'll make. It's pretty standard legal language to ensure people know where to go for more details. This section talks about who might be influencing shareholders regarding a proposed transaction. Essentially, it's identifying the key people involved in getting shareholder approval for certain deals. And this is a crucial legal bit. It basically says this report isn't trying to sell you any stock or convince you to buy or sell anything. It's just reporting on what's happened. All right, let's get into the meat of the filing. Item 1101 is where they report entering into significant agreements. And the first big thing they discuss is a simple agreement for future equity, or SAFE agreement. Accession Corp, which they call parent, along with a subsidiary called Merger Sub and another company they call the company, signed a merger agreement back on March 29, 2024. This is the overarching deal to eventually combine these companies. Now, the company was also supposed to get these SAFE agreements from investors before the merger. These are agreements where investors give money now, and in the future when the merger happens, that money converts into stock at a set price. They were aiming for at least $15 million in these investments. The really new information here is that on June 9, 2025, Parent and the company entered into a new SAFE agreement, specifically AFI Note Agreement number 3. As of the filing date, they've secured SAFE agreements totaling $6,497 and $207,297 and $209. What's interesting about these SAFE agreements is how they convert. When the merger closes, the money invested will turn into parent common stock at $11.50 per share. But there's more. On top of the shares bought with the investment, the SAFE agreements can also convert into an additional 94% of those shares. These extra shares totaling 531,075 will be held in escrow. They are tied to certain milestone events, so agreements can also convert into an additional 94% of those shares. These extra shares totaling 531,075 will be held in escrow. They are tied to certain milestone events, which sounds like performance targets that need to be met for the investors to get those extra shares. Think of it as a bonus for the investors if the combined company hits certain goals. Next up is something called the Commercial Funding and Repayment Agreement, or CFR Agreement dated July 15, 2020-2025. This is an agreement between a sponsor of Accession Corp, Accession LLC, and the company. This CFR agreement outlines some key commitments and deadlines. The company committed to using its best efforts to file its annual report, the Form 10K, with the SEC by July 21, 2025. They also had to close on another SAFE agreement, F5 Note Agreement, NOPS 15, respectively. These are all pretty standard deadlines for public companies, but it's good to see them being tracked and reported. Now let's talk about how money is moving around. On June 12, 2025, the company sent $520,000 from that safe. Note agreement, number 3 to parent. This money was for parent's working capital needs, meaning the day-to-day cash the company needs to operate, covering the period from May 12 to September 12. In addition, $150,000 of those safe funds went to parent as a partial repayment for outstanding bills, known as working capital accrued invoices. This included some late fees, and the repayment was to cover working capital and general corporate expenses. Parent then used this $150,000 to pay back some of its own bills. They also used some of these funds to repay a third ton of its own bills. They also used some of these funds to repay a $30,000 in Senegal corporate expenses. Parent then used this $1,550,000 to pay back some of its own bills. They also used some of these funds to repay a $13,000 bridge loan they had received earlier from their sponsor. Scroll in the safe note agreement number 4 when stims do business days of closing that safe. Note agreement number 4, another $200,000 will be wired to parent. Again, this is to help pay off those outstanding invoices related to working capital expenses. Parent will use that $200,000 to pay down more of its own loans. Finally, we have item 9.0. which lists the exhibits that back up all this information. This part is pretty straightforward. It just tells us what other documents are attached to this filing. They've included the actual template for the safe agreement and the commercial funding and repayment agreement we just discussed. And then there's the cover page interactive data file, which is for the computers that analyze these filings. The report is signed off by Noah Aptekar, the Chief Executive Officer of IX Acquisition Corp. This is standard procedure, confirming that the company is officially filing this report. The date of the signature is July 22, 2025. Now, putting it all together, what's the story here? IX Acquisition Corp is actively working towards a merger. They've secured some funding through these safe agreements, which is crucial for keeping operations going and paying down debts. The bulk of the money mentioned in this report isn't revenue in the traditional sense, but rather capital injections from investors in exchange for future equity in the combined company. The company is also committed to hitting specific filing deadlines and securing more funding. However, the report heavily emphasizes the risks involved, which is no surprise given they are essentially a shell company preparing for a business combination. Without more direct financial performance data for IX Acquisition Corp itself, it's hard to give a Warren Buffett style analysis of their current profitability. What we can see is a company in motion. They are signing agreements, raising funds, and pushing towards consolidating with another entity. The safe agreements, with their conversion into stock and potential for extra incentive shares, suggest a structure designed to align investor interests with the success of the future combined company. The company also seems to be managing its immediate cash flow needs and paying down existing debts, which is a responsible approach. The key takeaway is that this is a report about the plumbing of a business combination. It shows the groundwork being laid, the funding mechanisms being put in place, and the commitments being made. The real financial story will come once the merger is complete and the combined entity starts reporting its full operational and financial results. Until then, we'll be watching for those future filings for which the company seems to be setting the stage with these agreements. Alright, that's our breakdown of IX Acquisition Corp's latest filing. What's your take on these forward-looking agreements and the nature of companies like this? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more discussion and insights from the community. Thanks for watching. See you next time.